Budgets arrive with big promises and bold announcements. Tax relief, new spending, record investments. But for taxpayers, the real story is rarely in the headline figure. It's in the conditions attached, the timeline stretched, and the cost pushed into future years. Today, we are examining what the budget actually commits public money to, who pays, who benefits, and who's being asked to wait. Because behind every major announcement are assumptions about growth, revenue, and compliance, assumptions that taxpayers unfortunately underwrite. We look at what's funded, what's postponed, and what's missing entirely, and how these choices affect households, small businesses, and broader economy. This is the Money Show Budget Fine Print Special, where we test government claims against the numbers and ask whether taxpayers are getting value for what they are being asked to fund. I'm Kavita Khaplias, and to decode all of this, I have with me Mr. Arnav Pandya. Arnav, hi, good evening, and welcome to the show. Let's just talk about the relief measures and taxpayer impact first. The exemption of interest received on compensation awarded under Motor Vehicles Act has been pitched as relief. Now, who exactly benefits here? Accident victims, insurers, or both? And how meaningful is the tax saving in real terms?
So the real benefit of this specific deduction which is now available is that the person who receives the claim, and it could be the individual themselves or it could be the legal heirs in case it's a death case, when they receive the compensation is of two parts. It's the actual compensation plus often there is a lot of interest involved because the time period for this entire claim to come about is quite long. So the interest portion now is not going to be taxed. So it's a clear relief for the person who's receiving the money, which is the individual or their legal heirs. And the other important part is that there will also not be any tax deduction at source. So there is no problem of going back to the income tax department to claim the TDS which has been made. So on both fronts, interest income as well as the TDS relief, it's a benefit for the person or the legal heirs who's receiving this compensation.
All right. So, just wanted to understand, was this exemption long overdue given the nature, or you think it's an obvious step in the right direction?
No, so I mean, obviously it should have been there earlier, but because if you see, whenever there is a payout of this kind, normally the amount is exempt. But here, because of the interest component being taxable, there was a problem in terms of showing that in the income tax return, paying some tax on this. So, which has now been addressed and which is a good thing for anyone who's receiving these kind of claims.
All right, but then how do we look at it? Was this exemption long overdue given the nature of compensation, or does it open the door to similar claims in other compensation related cases as well? How can we look at it going forward?
So if you look at it, this was required because this kind of compensation which is received is not an income for the individual or their legal heirs. So one, it was definitely required. And ideally, wherever you receive this kind of amount through compensation, it is normally not taxed. And hence, if they apply this template across various kinds of compensations, then that would be really a boon for the people who are receiving it because they will not be subject to any unnecessary and additional taxes.
Let's also talk about compliance and ease of doing taxes. Now, allowing a Form 15G and 15H filings to depositories is being sold as simplification. How much paperwork does this actually eliminate for retail investors? And are there any compliance risks in centralizing these filings now?
So you see today what is happening is that say you have a portfolio of say 12, 15 stocks in your demat account. Now, if you are a person for whom there has to be no tax deduction at source on the dividends, then whenever each individual company declares their dividend, you have to go and apply to that company or their registrar and transfer agents and tell them that please do not deduct tax for me because I am in the exemption category or my income is not taxable. Now, the proposal is that instead of going to each individual company, and this could be a large number for all the holdings which you have in your portfolio, all that you do is you give this kind of declaration to the depository. and the depository will give that information to all the companies which are there in your portfolios. This is exactly what happens when you say you link your bank account to the depository, because then the depository itself goes and gives this information to all the companies which are there, and you automatically receive the dividend payments in your bank account. So this is similar to that. So it eases a lot of the paperwork which an individual would have to do when they have to go and give these kind of declarations to each individual company. The only catch here is that one has to be very careful, because this provision will be applicable from 1st April of 2027. So it's not going to be applicable after 2 months. It's going to take a year and 2 months, after which it will be applicable. And that is also logical, because the depository has to set up such a system so that they can collect this information and then pass it on. So this is a good move in terms of saving paperwork, but just one has to be careful. It's some time before you are going to get this kind of benefit.
We cannot look at this shift, as something which is very meaningfully introduced to reduce errors and duplicate deductions. Is it primarily an administrative convenience? That's how we should be looking at it?
Yes, it is definitely primarily for administrative convenience. It saves a lot of effort for the individual investor and taxpayer. And it is mainly senior citizens who have to do this kind of thing, because normal working people would obviously have some taxable income. So they do not make use of it. It's for ease and specifically for senior citizens. And in India, senior citizens have a lot of investment. So they are the ones who are primarily going to benefit from this.
Mm-hmm. Filing deadlines and small businesses, a very important update over here. The due date for business and professional taxpayers not requiring audit has been extended to 31st August. Now, is this a genuine acknowledgement of compliance pressure or small businesses or just a marginal tweak? How should we look at it?
No, this is a problem which occurs every year. See, because the thing is that every individual has some tax deduction at source. Specifically, for anyone who's in business or profession, they will have a large number of these kind of TDS things. Now, what happens is that for, say, an person who's a salaried individual, they just have to collect Form 16 from their employer, and maybe the uh, form from their bank if there is some interest on which TDS has been done. But for a businessman or a professional, they have to collect these kind of, or these TDS have to be generated from a lot of places. And the problem is that many times, even though the deadline might be different, it comes up till, say, the first week of July or the second week of July before these kind of certificates are actually available for the individual. So it always becomes a time pressure by the end of July for them to file their return. So this kind of movement of the due date to 31st August is practical, and it was required, because if you remember earlier, the due date was 31st August, which had been shifted earlier. Right. So this is practical, useful, and it will benefit all these taxpayers in terms of ensuring that they are ready by the due date to file their returns, and it eases a lot of these kind of time pressures and problems which occur normally, or which has been occurring in the past few years.
All right, so a relief as far as time pressure is concerned. But then, let's also talk about quiet withdrawals of tax benefits. Now, interest spent on earning dividend income from mutual funds will no longer be allowed as a deduction. Is this a clear case of the government broadening the tax base quietly while announcing relief elsewhere?
No, this is, I would say, it's a way to ensure that people do not borrow money and then invest, because it becomes like a means of speculation. So the idea is that earlier, if you receive this kind of income from dividend, then you could set up 20% of the amount as a cost if you had borrowed money and you had paid interest on it. Now, the idea for the government is to ensure that you are investing your own money and earning dividends. It should not be that you are borrowing and then investing and then getting dividends, because it becomes like a speculative play. It's a kind of leverage which an individual investor or even other investors should not be taking. The goal of the government is to try and discourage this kind of thing, which is why they've eliminated this benefit. So now the thing is that if you receive dividend, then you will not be allowed anything as a set-off, because earlier this kind of small provision was there, whereby you could reduce your gross income, since this is income from other sources. But Here, now what will be happen is that the entire amount which you receive as dividend will be considered as taxable income, and you will not get any other deduction on it.
So, which category of investors will feel this the most leveraged investors? We are talking about high net individuals over here, or we're talking about retail participants.
No, normal retail people, I mean, normally don't borrow for these kind of investments. It's
Right.
usually specific people who either want to uh, do some speculation, or they have a slightly higher net worth, who can afford to get funds at a slightly cheaper rate, and then they do this and try and earn dividends. But for a normal individual who's investing his money through the SIP route and who's constantly trying to build their own wealth, for them this has no impact because most of them would not be doing this kind of thing anyways.
Got it. Now, a very important development. This is tax-free income on sovereign gold bond will now apply only to those who invest in the original issue and hold till maturity. Does this reduce liquidity and flexibility for investors who previously relied on secondary market exits? What happens to them? How much will they be taxed now?
So one thing is definite, that see, the initial goal of this entire provision was that you invest in these sovereign gold bonds, hold it till maturity, and any gain that you have will not be taxable. Now the problem which has occurred in between is that gold prices have shot up significantly in the last 2 3 years, and this actually led to the government having to stop the issuance of new what you call tranches of the sovereign gold bonds. The impact that this had was that even people who wanted now to get into the sovereign gold bonds use the secondary route, and which increased liquidity. But what it did was also it led to a premium for the prices in the secondary market, because investors were chasing these existing bonds and not every investor who had invested in them wanted to sell. So this kind of premium was seen in the secondary sovereign gold bond market. Now the government has clearly cracked down on this and saying that if you have bought in the secondary market, then you hold till maturity, this tax benefit is not available to you. And it's a significant thing because you have to remember gold prices have gone up tremendously over the last 2 3 years. So anyone who's having these kind of uh, gold bonds when have bought it slightly before, you are going to see a lot of gains here. And now for the secondary bondholders, this is going to be taxable. So this is a move which the government wants to restrict the benefit to only the original allottees, and it will definitely have an impact in the secondary market, as you have said, because now there is no incentive for people to go out in the and buy these bonds in the secondary gold
Right.
market. If people want to have an exposure to gold, they can very well go and buy a gold ETF. So this kind of tax benefit going away will have a significant impact on the liquidity in the secondary market too.
Right. So this effectively discouraging the secondary market participation in sovereign gold bond. But then, let's also talk about buybacks and capital gains. Now, buybacks will now be taxed as capital gains in the hand of investors. The government says this reduces tax liability, but does it really, or does it simplify shift the tax point?
No, see, definitely for an individual investor for whom, if you look at the past provision, this got entire amount got taxable as your normal income. Now, the normal income, if you are falling in the 30% tax bracket, your tax liability on it straight away goes up. Now, since there is a clear definition of the fact that whenever there is this kind of buyback, you have a gain which will be taxed as capital gains, your rate automatically comes down. See, the rate is different for promoters and as well as entities who are holding as promoters. So for them, the rates are higher, but for an individual, it's a significant thing because they are going to ensure that since it's classified as capital gains, you will have a lower rate of tax on it. And this also takes into account the problem which was there earlier, that if you had a loss on it, what could you do with it? There was nothing that could be done since the entire amount was taxable as normal income. So it ensures that now there is a real way in which the taxation of these kind of buybacks are there, and the impact of this, I think, is going to be very evident. You will see a lot more buybacks happening in the coming periods as these guidelines now become applicable.
All right, I think with that will be all. And definitely, the union budget impacts every financial decision in the country. To know its impact on your wealth, definitely, which is why we got this discussion, which gives you clarity as a taxpayer, as an investor, in formulating your strategies ahead. Thank you so much, Anna, for being on the show and helping our viewers understand the budget outcome and the fine print very well. And with that, it's a time for a short break. But then post that, we'll be joined by our expert Pankaj Matpal, who will be answering your portfolio queries and especially your budget-related queries, which have been trickling down. So stay tuned.